What's going on, YouTube? Welcome to another edition of the Principles Experience. My name is Kevin Jenkins, and you now are watching the 19th episode. And what I want to discuss today is fiscal and monetary policies and how these policies influence economic activity within our economy. Now, when it comes to how decisions are made within our society from an economic standpoint, they are often influenced by the government, which is fiscal policies, and the Federal Reserve, which is monetary policies. And most of the time, these policies affect the growth of GDP. Now, you may ask, what exactly is GDP? GDP is the gross domestic product, and this pretty much measures all of the business activity within the U.S. GDP is also calculated by adding all of the goods and services within our country. And also consumer spending, government spending, and business investments are all included in the GDP. So let's go further into what fiscal policy details. So this policy is government actions which are approved by Congress that implement and impact economic activity. Fiscal policy can be implemented to increase or decrease the take-home pay of the American public by changing tax rates, changing transfer payments such as Social Security, or altering government spending on goods and services. Now, whenever the government needs to stimulate the economy, which is going on right now, they will usually do what I briefly mentioned. They are going to either change tax rates, they're going to alter government spending on goods and services, or they're going to increase the transfer payments, the Social Security, to the American public. And with everything that's going on right now with COVID, they will tend to even cut tax rates a little bit more to help individuals. And they're also going to increase that government spending to give more aid to the American people. Now, to slow down the economy, the opposite is going to happen. And when the government wants to stimulate the economy, especially if there's a recession like it was back in 2008, the government will have Americans pay lower taxes. Their goal is to have Americans pay lower taxes, which will allow them to have more money to spend or invest, which in result is going to fuel higher demand. Now, the demand will lead to lower unemployment. More firms are going to look to hire more workers, and it's also going to create competition for labor within the workplace as well. Now, an example of how fiscal policy has been used in 2020 is when the government decided to send stimulus checks to Americans back in the spring of this year. And this was part of the $2.2 trillion economic relief program. And when this happens, the government is trying to prevent the economy from going into a recession. So stimulus checks, they could be a form of lowering taxes, which can lead to more consumption and also saving amongst consumers as well as businesses. Now, another way fiscal policy can be used to help the economy is tax deferrals, support for specific industries that have been affected. I know with everything going on now with the airlines, with the theme parks, with the cruise lines, they need more help than any other industry. And I know that Disney, earlier this week, they just laid off 28,000 workers. So I wonder if there's going to be any type of relief program for theme parks. And also, I know that the Federal Reserve is working on a relief program for airlines. They're talking with a lot of different CEOs of airlines because they have also struggled on their balance sheet with acquiring revenue due to the limited travel with everything going on now with COVID. Now, you also have loan deferrals, which is another factor that can be used to help the economy. And as you can see right now with the federal student loans, those have been put on hold and they have been deferred until December 31st, and there's no interest being applied to the federal student loans. So that's also helping student loan borrowers, and the government, they'll tend to do these different things to help the economy and stimulate the economy. Now, to understand fiscal policy more in depth, there was a gentleman, his name was John Maynard Keynes. He was a famous economist back in the 1900s that created what's known as the Keynesian Theory. And what this theory explains is how fiscal policy is a means to achieve full employment within our society. Now, Keynes believed that the economy operates at an equilibrium level, and equilibrium simply means the state of the economy being balanced. And equilibrium is usually determined by the forces of both income and spending. Back during the Great Depression, all the way back in the 1930s, the equilibrium level was low because income and spending was low. So Keynes felt that the consumption was the driving force behind growth. And to stimulate consumption in the economy, Keynes advocated to increase government spending and transfer payments to individuals. And when this theory was implemented during World War II, the economy shortly took off afterwards, after this theory was implemented. So this really just goes to show you some of the benefits of how fiscal policy has an impact on our society and how it can influence economic activity. So the next topic I want to get into is monetary policy. So when it comes to monetary policy, these actions are placed from the Federal Reserve to influence the growth of the money supply within our society. Now, the Federal Reserve is simply, they're the central bank of the United States. Their purpose is to provide the country with a safe, a reliable, and a stable financial and monetary system. They play a big role in regulating banks and just the money supply that's being facilitated throughout the economy. Now, by expanding the money supply, the Federal Reserve, they will loosen credit and lower interest rates. This tends to help stimulate the economy. Now, by tightening the money supply, the opposite occurs. So usually when the Federal Reserve is loosening credit, banks are more likely to issue credit to the consumers, such as credit cards. They may be likely to issue loans at a very low interest rate. So let's say you're looking to purchase a car or a home. They do these type of things to help stimulate the economy, to make people spend or either to invest. Now, lowering the interest rates on these activities, like I said, it's going to help tremendously with economic growth, because if you have a low interest rate on, trying to finance a vehicle and you do it through a specific bank, you're going to be more willing to take that offer because your interest rate tends to be low. Now, the purpose of this is to control inflation, consumption, growth, and also liquidity. Now, for those of you that may not know what inflation is, it simply is a general increase in prices and fall in the purchasing value of money. So this is accomplished when the Federal Reserve modifies interest rates, buying or selling of government bonds, regulating foreign exchange rates, and changing the amount of money that banks can have within their reserves. And monetary policies are used to help rise GDP. That tends to be their goal, and also to help maintain a low level of unemployment. And the Federal Reserve, they also have a dual mandate to achieve maximum employment while keeping inflation in check. So mainly their responsibility is to balance economic growth and inflation. That's really all they're focused on within their specific department. Now, oftentimes when there is an increase in the money supply, this will lead to higher inflation. So in order to combat with that, a lot of times the Federal Reserve, they will increase interest rates because they're trying to slow down the growth of money supply and they're trying to lower inflation. So it has a counterintuitive approach to it. And, the Federal Reserve, they kind of go off of what's going on in the economy. They kind of forecast what they expect to happen in the future. And then they make the decision if they need to either increase the interest rates or, lower the interest rates to help stimulate the economy. Now, the last concept that I wanted to point out is there are two other theories that discuss fiscal and monetary policy. And the first is the supply side theory. This theory argues that excessive government spending and taxation stifles individual initiatives. And therefore, by reducing government spending and reducing taxes, individuals are given the incentive to produce. And this is the true key to economic growth. Now, I totally agree with this specific theory, the supply side theory. And there's a quote that stands out to me that relates specifically to the supply side theory. And it states that if you give a man a fish and you feed him for a day, or you can teach a man how to fish and you can feed him for a lifetime. And this is by Lao Tzu. And basically, what I got out of that is that the government, it cannot save it cannot save everyone. And focusing more on how you can produce for yourself and not relying on these government relief programs is what's going to allow you to thrive in life. And I think when we're giving stimulus checks, when there's an increase in Social Security, it keeps people comfortable, because there's a clutch that they can lean on. But when you take away the government spending, it allows people to figure out different creative ways of how they can make income for themselves. And I know for me personally, I lost my job back in February due to COVID. By the grace of God, I am working now at the moment. But when that was going on all throughout that time, I was thinking of ways of how I could produce income for myself. And I was looking at of how I could become an entrepreneur and how I can control my own destiny. Because I think that, kind of like what the quote says, if you give a person a fish, they're only going to learn how to fish for that specific day. But if you teach them how to fish, if you teach them how to invest, you teach them how to create income for themselves, they're going to be set for a lifetime. So I think that, this supply side theory, I really agree with that one. And I think I apply that, into my life on a daily basis. Now, the last is the monetarist theory, which explains how fiscal policy is not the main determinant of economic activity. Rather, they feel that the actions of the Federal Reserve Board is the driving force behind economic cycles. And I believe when it comes to this theory that, I can agree to that as well. But I think that the economy, it needs a balance of both fiscal and monetary policies. One cannot withstand on its own. The government needs the Federal Reserve and the Federal Reserve needs the government. So when the economy has government actions that stimulate the economy, when interest rates are low due to Federal Reserve actions, and when money supply levels are sufficient to support continual growth in our economy, I believe that that's when we are in a true monetary economy where everything is efficient with the supply levels and what's going to lead the economy to more success and more growth. So that pretty much wraps it up for this episode. I thank you so much for you all for watching this video and for supporting me throughout this journey. If you all can please like, subscribe, and share this video, I would greatly appreciate it. Tell a friend to tell a friend, tell your family members, spread the message of financial literacy. And I want to thank you all so much for tuning in to another episode of the Principles Experience, and take care.